Quantitative easing versus tightening. What actually happens to your money? Imagine you wake up one morning, stretch, check your bank app, and somewhere far beyond your coffee, your landlord, your hustle, and your grocery bill, a group of very serious people in expensive suits has quietly changed the gravitational field of money. Not by stealing your cash, not by opening your wallet, but by changing the plumbing underneath the whole financial system. And suddenly, your mortgage feels heavier, your savings feel weaker, stocks start levitating like they've seen a ghost, and the price of bread begins acting like it has a law degree. Welcome to the mysterious world of quantitative easing and quantitative tightening. Or, as normal people call it, why does my money feel weird? Today, we are going deep, but not lost. We are entering the vault. We are pulling back the curtain. And by the end of this story, you'll understand what central banks are actually doing and what it eventually does to your money. The first big lie. Let us begin with the first big lie. When people hear quantitative easing, they picture central bankers tossing cash from helicopters like confetti at an economic funeral. That is not really what happens. QE is not usually the central bank mailing everybody a suitcase full of fresh bills. It is much more technical, much more boring, and therefore much more dangerous to ignore. The Bank of England defines QE as creating money electronically and using it to buy government bonds from private investors. The Fed describes its version as large-scale asset purchases intended to push down long-term yields when short-term rates are already near zero. So what is QE? Here it is in plain English. The central bank creates reserves electronically, then uses those reserves to buy financial assets, usually government bonds, from the private sector. That's it. No dragon, no wizard staff, just balance sheets. Which, to be fair, is exactly what a wizard would say if he worked in accounting. The money plumbing. To understand QE, you must understand one crucial distinction. There is money you use, and there is money banks use. When a central bank does QE, it creates bank reserves. These are not the same thing as cash stuffed into your pocket or deposits instantly handed to every citizen. They are balances used inside the banking system. The ECB explains that base money consists mainly of banknotes and central bank reserves, and those reserves are what commercial banks use to settle payments with each other. The Fed likewise frames the size and composition of its balance sheet around assets held and liabilities such as reserves. So imagine this. A pension fund holds a government bond. The central bank buys that bond. The seller now has cash-like proceeds. The banking system now has more reserves. The bond supply available to private investors shrinks, and investors, now holding more liquid assets and fewer bonds, start looking elsewhere for return. That elsewhere matters, because that is where the ripple begins. Why central banks do this? Central banks typically reach for QE when the economy is in trouble and their usual weapon, short-term interest rates, is already near the floor. That was the story after the global financial crisis, and again after the COVID shock. The Fed has stated that QE was used when the policy rate was at or near zero and further support was needed, while the Bank of England says QE is used to lower long-term borrowing costs and support spending in the economy. IMF research also describes QE as especially important when policy rates are constrained by the effective lower bound. In other words, when the normal medicine stops working, the doctor opens the cabinet marked unconventional, and out comes QE. How QE moves through the system. Now the real question. If the central bank is buying bonds from giant investors, what does that have to do with you? Everything happens through transmission. When the central bank buys a lot of longer-term bonds, bond prices tend to rise, and when bond prices rise, yields tend to fall. The Fed says QE was intended to reduce long-term interest rates by lowering yields on longer-dated securities and compressing term premia. The Bank of England similarly says QE lowers long-term borrowing costs. So that can affect mortgages, business borrowing, government financing conditions, and asset valuations. So QE can make financial conditions easier. Loans may become cheaper. Investors may move into riskier assets. Stocks and property may get a tailwind. Confidence may improve. And if all goes well, spending and investment rise, unemployment falls, and deflation risks ease. That's the theory, the sales pitch, the glossy brochure. What QE feels like in real life. But theory is not the same thing as lived experience, because QE doesn't land evenly. If you own assets, stocks, bonds, real estate, QE can feel like someone quietly inflated the floaties under your portfolio. If you're a saver living on safe yields, QE can feel like your bank account got sentenced to a lifetime of disappointment. If you're trying to buy your first home while asset prices are lifting off like a SpaceX launch with no seat for you, QE can feel less like rescue and more like watching rich people receive oxygen masks in first class. IMF work and central bank research describe several channels through which QE affects markets: lower long-term yields, portfolio rebalancing, improved liquidity, and easier financial conditions. So QE can support growth, but they can also raise the prices of financial assets more directly than wages. So when people ask, did QE help the economy? The honest answer is, it can help stabilize the system, but the benefits and side effects are not distributed like birthday cake, more like a family inheritance dispute. Enter quantitative tightening. Now let's meet QE's colder, stricter sibling, quantitative tightening. Quantitative tightening is what happens when the central bank starts shrinking its balance sheet. Instead of buying lots of bonds and adding reserves, it stops reinvesting maturing assets or even sells assets outright, and reserves in the banking system decline as the balance sheet contracts. The Fed's May 4, 2022 plan said balance sheet reduction would begin on June 1, 2022, mainly by limiting reinvestment of principal payments on securities holdings. The Fed later reported that its securities holdings had fallen about $2.2 trillion since runoff began in June 2022. The ECB says its APP portfolio began declining from March 2023 as it stopped fully reinvesting maturing securities. Translation? The central bank is no longer flooding the system with support. It's slowly draining the punch bowl. Not by smashing the table, by quietly removing the ladle. What QT does to your money? QT tends to work in the opposite direction of QE. If fewer bonds are being bought by the central bank, the private market has to absorb more of them. That can put upward pressure on yields. Liquidity can become less abundant. Financial conditions can tighten. The ECB says QT is part of withdrawing policy accommodation, reducing a large central bank footprint in markets and regaining policy space. Fed materials describe balance sheet reduction as part of firming the stance of monetary policy alongside rate hikes. Research from the IMF suggests QT may be less symmetrical than QE and can have meaningful market and macro spillovers. So does that mean your checking account visibly shrinks overnight? No. That's where people get confused. QT usually doesn't mean the central bank reaches into your account and deletes your lunch money. It means the environment around your money changes. Credit may get tighter. Asset prices may lose support. Borrowing may become more expensive. Risky markets may wobble. Growth may cool. So your money's effect is often indirect, but very real. Your money starts living in a harsher climate. Same dollar, less tropical weather. The most important distinction. Here's the part that separates understanding from internet chaos. QE increases reserves. That doesn't automatically mean banks suddenly spray loans into the streets like confetti cannons at a parade. Banks don't lend simply because reserves exist. They lend when borrowers are creditworthy, regulations allow it, and profitable demand exists. Central bank balance sheet policy changes the incentives, prices, and conditions around lending and investing, but the path from reserves to consumer inflation is not one straight pipe. It runs through financial markets, bank behavior, expectations, fiscal conditions, and the broader economy. This is why someone can scream, "They printed money," and still not understand what actually happened. Yes, reserves were created. No, that does not mean every new reserve became a sandwich, a used Honda, and a rent increase by lunchtime. Though, admittedly, sometimes it feels like it did. So does QE cause inflation? Now we step into the danger neighborhood. Does QE cause inflation? Answer: it can contribute to inflationary pressure under some conditions, but it's not a simple one-button cause. QE is designed to stimulate demand and ease financial conditions. But inflation outcomes also depend on supply shocks, fiscal policy, energy prices, labor markets, and whether the economy has slack or is already overheating. IMF analysis notes that QE can support output and inflation when rates are pinned near zero, while later IMF work also discusses criticism that large post-COVID asset purchases may have helped fuel the inflation boom alongside other factors. So if the economy is weak and frozen, QE can help thaw it. But if the system is already hot, constrained, and drowning in stimulus from multiple directions, more liquidity can become gasoline near an open flame. That is why this is not theology. It is timing. Economics is basically the science of asking, how bad could this get if humans panic in the same direction? And then being shocked every decade when the answer is worse. What happens to savings, wages, investments, and debt? Let's make it painfully practical. 1. If you are a saver, QE can push safe yields lower. Your savings may earn less. Cash may lose relative power if inflation later rises faster than deposit returns. The Bank of England explicitly says QE lowers long-term borrowing costs. That same dynamic can compress returns on safer income assets. 2. If you're a borrower, QE can help lower financing costs. QT can work the other way by tightening conditions and supporting higher yields. That can matter for mortgages, auto loans, and business credit. 3. If you own investments, QE often supports valuations by lowering discount rates and pushing investors toward risk assets. QT can remove some of that support. 4. If you live on wages, the effect is slower and messier. If QE supports jobs and growth, labor markets may improve. But if later inflation outruns wage growth, households feel poorer in real terms. So when people ask, what happens to my money? The best answer is, QE and QT change the value of your money's environment before they change the number printed on the note. They alter the battlefield: interest rates, asset prices, credit availability, and inflation pressure. Your wallet is the last domino, not the first. The darker rabbit hole. Now for the deeper rabbit hole. When a central bank buys huge quantities of government bonds, it does more than tweak rates. It changes market structure. It changes who holds duration risk. It changes liquidity patterns. It changes the price signals everybody else uses. The ECB has said QT is partly about reducing the central bank's footprint in financial markets and regaining policy space. Fed research also notes that the size of the balance sheet matters for reserves, liquidity absorption, and rate stability. So this is not merely about printing or destroying money. It is about power over the architecture of finance. And architecture matters,
because if you tilt the floor of the financial system by even a few degrees, trillions of dollars begin sliding before ordinary people even realize the room is not level. The one-sentence summary. Here is the whole story in one sentence. Quantitative easing makes money and credit conditions easier by expanding the central bank's balance sheet and buying assets. Quantitative tightening does the reverse by shrinking that balance sheet and removing some of that support. Or even simpler, QE says, take a deep breath, markets. QT says, walk it off. So the next time someone says the central bank printed money, ask them, printed what? For whom? Through which channel? Into which assets? Under what conditions? And with what lag? Because grown-up economics is rarely about slogans. It is about mechanisms. And once you understand the mechanism, you stop being hypnotized by headlines. You start seeing the machine. And that is when money stops being mysterious. If this video helped you finally understand QE versus QT, type balance sheet in the comments. Subscribe for more deep dives into money, power, and the invisible machinery running beneath everyday life. And remember, your wallet may be in your pocket, but the weather around it, that's made somewhere else.